Hello, trading friends, and welcome back to Forex Focus, brought to you by IG. Taking a look at the dollar yen once again. Really been one of the most volatile major pairs in Forex for the first month or so of the year, which is totally unexpected. Traditionally, if you were to go back last several decades, the yen, one of the most stable major currencies against the dollar, but not recently. A lot of back and forth in this pair and a lot of upside in recent trading. Dollar rising once again, yen crashing back to close to 30-year lows after non-farm payrolls comes in really hot in the US, and a lot of expectations shifting out in time for US rate cuts, which is good if you're holding dollars and not so good if you're holding yen. But we'll look at the non-farm piece in just a second. First, let's take a look at the price action coming out of this event, because it was a lot of rallying in US dollar and pretty unrelenting post non-farm, as dollar yen broke through 148 and rose over 150 pips. This market was up at one point over 200 pips. Huge move in dollar to the upside as non-farm comes in so much hotter than expected. But yeah, you see some of the price action here just really on a historical basis, not what you expect in a given day from the dollar yen, but it's been one of the most volatile pieces here recently, and we'll get to that more in a second. But first, let's just give you the context on this non-farm number, because it was expected around 170 to 180,000 jobs added. It comes in at 353, and now this is the second month in a row that they hit the over on this number, and a lot of people who maybe thought last number was a one-off, thinking, man, inflation might be a little bit stickier than we expected. Chances of inflation reversing back to the upside maybe higher than expected. And now chances of interest rate cuts lower than previously expected, as we have now less than a 20% chance of a rate cut coming in March. You'll remember that about a week ago, this was around 50%. And in recent months, especially at the end of 2023, when the dollar was really weakening, this chance of a rate cut in the March FOMC meeting, which is now the next Fed meeting, was as high as 75 to 85%, really high chances, and a lot of that has been priced out. And as that's been priced out, strength in the US dollar has been priced in, with the understanding, theoretically, that higher interest rates in the US for longer means more demand for those dollars and those higher rates, especially relative to Japanese rates that have been negative this whole time. And you look at the historical price action in this yen, and a couple of things. One, it has been able to bounce back and reverse. As recently as this past week, we saw a really big yen rally, but inevitably the dollar strength has fought back, and now we're just a couple hundred pips away from those 30-year highs that you see we've traded a couple times. The 150 number has really been the approximate high for dollar yen over the course of not just the last couple of years here, but that's going back to the early 90s. That's a 30-year high. And most recently, they broke through 150 and traded above 151 for a little bit. And now, after this non-farm number, the market rallying right back up above 148. And like I say, a few hundred pips away from those 30-year highs. It'll be really interesting to see if they get back up to that level and to a new high, or if they reverse lower. And just a little bit of added context as to why this pair has been one of the most volatile pieces is because it really is U.S. data specific, with the idea that the euro versus the dollar over recent years there's been at least some competition, right? When U.S. inflation spiked and U.S. interest rates spiked and U.S. economic data was outperforming over the course of the last 2 to 3 years, similar data points and similar rate hikes were occurring in the euro area or in the UK or even in Australia and Canada as well. And that just didn't happen for Japan. Their economy didn't bounce back from the pandemic as well as the US's did, and they actually didn't hike interest rates at all. And so you see these huge swings of dollar strength when they're pricing in one, higher interest rates in the US, or recently it's not even that they're pricing in more rate hikes, it's just that they're pricing out rate cuts. So the idea being, and this is just an example, theoretically, if the Fed were to cut interest rates all the way from above 5% down to 0% in the US, the dollar would probably weaken significantly against the yen. But if they don't cut at all and they stay above 5%, then this dollar might hold on to its highs. Now, of course, the Bank of Japan can come in at some point and maybe hike, but they haven't done that in, I think, more than 20 years. It's been at least a decade since they've hiked interest rates from the Bank of Japan. But a lot here on the table, just looking at the most recent price action. And with this run up, a lot of clients on the short side of this dollar looking for that bounce back in yen, which you have historically gotten at certain periods, looking for that reversion lower in dollar. 73% of IG clients with positions in this market short dollar, long yen. Now, of course, this market can continue to those all-time or those 30-year highs, of 151, or it can reverse lower, which is what the 73% would like, of course. But only time will tell. There will be more economic data from both the U.S. and Japan throughout February, and that will culminate in that March FOMC here in the U.S. in mid-March. Plenty of stuff on the board for dollar-yen trading. Until next time, thanks for watching.